Is the stock market on its way to a huge crash? This is the question that is on the minds of so many people after all that is going on in the stock market. And so in order to answer that question, we have to get a couple things straight. The first thing is that crashes are bound to happen. It's just a matter of time. Now, this fact can consume a lot of investors, especially investors that just start putting money in the market because they're afraid they're gonna put their money in and then immediately the stock market crashes. But if you are a long-term investor, you may have gone through moments like this, and so you know exactly how to handle the inevitable crashes. But for anyone that is investing in the stock market, whenever crashes happen, a good investor is always excited about them happening while they are building wealth, while they are starting to put money in the market. Because it is at that point when crashes are happening that while you are putting money in, you are gaining wealth because of the eventual rebound. Now, on the other hand, if you are in the phase where you are living off of your portfolio in what we call the drawdown phase, where you're pulling money to live off of every day, a crash can be a very scary thing. You must have a backup plan. So this is the first thing that we need to get straight.
The second thing is that historically, no one has been able to predict a crash. Now, there have been certain investors that have been credited with predicting, for example, the 2008 crash. But if you look at those same investors, they're always throwing out different dates of different crashes that are expected to come, and they never come. So if you are basing your investment plan off of news of certain predictions about when the crash is going to happen, you are basing your plan off of mere speculation.
The third point is that stock market crashes can happen very fast or they can happen very slow. And I'll give you a great example of this. March of 2020, we experienced one of the fastest crashes in the history of the stock market. Over a 22-day trading period, the stock market lost more than 30% of its value. Now that is considered a super fast crash. On the other hand, here's an example of a super long crash. January 11, 1973, when the S&P 500 took 373 days to fall 30%. 373 days to fall 30%. You don't even realize the crash is happening at that point. So on one end of the spectrum, you have a crash that takes 22 trading days. On the other hand, you have one that took 373 trading days.
And we have said this before, but it is so important to mention that historically, the stock market has always recovered from a crash. Now, I want to be clear about this because we talk about the stock market as a whole recovering. If you're investing in individual stocks, it's very possible that those individual companies can fall out, they can go bankrupt, and they may never recover. But if you are investing in the total stock market as a whole, for example, a total stock market index fund, that type of investment has always gone up in the long run. So what we have now are 5 different things that you should do during a crash.
Our first tip to prepare yourself, and this is really a pet peeve of ours, is to decide whether or not you are an investor or you are a trader. You need to make up your mind in this regard. We get so many questions from people that are talking about trading their 401k, jumping in and out of stocks on a daily basis with their retirement accounts. If you are a trader, you are looking for short-term gains with all of this volatility. You're looking for 1 or 2 or maybe 5% every time the market makes a move on a daily basis. On the other hand, if you are a long-term investor, you are looking for long-term growth of your investments. You build wealth by consistently investing in the stock market over a long term so you can reap long-term growth of your assets.
The second tip is to beware of your emotion-driven reactions to the volatility in the stock market. A lot of people are so anxious during these dips and crashes that they tend to sell at a loss. And then as the stock market begins to recover, then they want to jump back into the stock market and buy as the stock market is going up. So they're buying stock once the prices go back up. This is the exact opposite of what you want to do when you're investing. But when you have that emotional component tied to your investments, that's how many people tend to invest. The exact wrong way that they should be investing. So be aware of your emotions during each crash.
Our next tip is to buy the dip. And you may have heard this before, but the concept is that when the stock market or an asset that you are following, if it's an individual stock, for example, when you see that asset fall to a certain point because the market is crashing, you go in with the extra money that you have on the sideline and you buy that asset. It is on sale. You are buying the dip. Our next tip is to diversify into other investments. We love investing in the stock market, but for us, it's not our only investment. You know that we also invest in real estate. And so for a lot of people, if you are building wealth by investing in the stock market, that means that all of your wealth may be tied to the winds of the stock market. And that is an all right strategy until the market crashes and you have to live off of that wealth that is tied up in the stock market. But if you have a diversified portfolio of other investments, you can switch over to those other assets when another is not doing as well.
And just to piggyback off of that a little bit, if you are investing in the stock market, you also want to make sure your investments within the stock market are also diverse. And then if you're only investing in the stock market, you want to have that strong emergency fund so that you can live off of that rather than pulling from your investments during that crash or the dip.
And our last and final tip is before you put $1 into the stock market, you must have an investment plan in place. An investment plan will save the day when these crashes come along. And we think that your investment plan, it doesn't have to be complex, but it should certainly be automated. It should not be a plan where you manually have to go into your account every single month and buy your assets. It should be something that is pre-set up and those investments are automatically being made every single month. So that when volatility like this happens, you're not sitting at your computer looking at the stock market thinking, well, maybe I'll hold off on buying this month. No, you want to take the emotion out of your investment journey by automating your investments with an investment plan.
So we have a stock market investing course where we talk all about investing in the stock market, and we also provide an investment plan so that by the time you're done with a 4+ hour course, you have a complete investing plan to help guide you on your FIRE journey and help guide you during those dips and crashes in the market. So if you are interested in enrolling in the course, make sure you check that out. We will leave a link in the description below, or you can also go to our blog at ourrichjourney.com. So if you like this video, make sure you give us a thumbs up, subscribe to our channel, and
join the journey.